Hey everybody, I'm John VanDuzer, CPA and partner with James Moore and Company, and I'm here with Kevin Golden, tax director, and we're both part of the real estate services team here at James Moore, and we're continuing our discussion on tax planning for real estate operations. So if you haven't watched the first video in this installment, we go all over depreciation, everything you ever wanted to know about depreciation. And so in this video, we're going to hit a few other topics related to the real estate operations. So Kevin, we talked a lot about depreciation. The benefit of depreciation is we create a lot of losses. But then you have to think about what happens to those losses when they go and flow down to the individual level. And are you able to get benefit for those losses? And so one of the biggest areas to deal with in real estate is the real estate professional classification. So why don't you walk us through, maybe give us a quick intro to the passive activity rules, and then
Sure.
why real estate professional is so significant.
Definitely. So real estate, anytime there's any tax law or anything at all, real estate gets its own special section. That's just because there's so many moving parts, all right? So basically, let's talk first about passive versus non-passive, right? So generally, real estate by default is a passive activity, right? And what that means is basically it is an activity in which it's not a normal operating, trade or business, right? Such as, somebody who may be a manufacturer who sells widgets, right? The IRS doesn't see it quite like that, right? And so instead, if someone is passive in an activity, right, then by default, what happens is they cannot take those losses until they have income to offset it, right? Or in the case of real estate, maybe they get rid of that property. Then those losses that they weren't able to take because they're passive, they're able to, right? So it's very limiting. It can slow down your timing of when you get those deductions. Eventually you'll get them, but it's a matter of when, right?
And those rules are all designed from stopping you from sheltering basically your active income
Right.
with passive investments. So for you and I, we're accountants, and barring any special circumstances, if we go invest in rental properties, we're going to be subject to these passive activity rules, and any losses that we have on those activities aren't able to offset our day job, which is being accountants.
Right. Definitely.
So, real estate professional, how does that interplay with all of these?
Yeah. So the IRS does recognize, though, like many of you, there are people who do this on an ongoing basis. They're not accountants or have some other day job that really they spend all their time. They live and breathe real estate, right? So the IRS came up with what's it's not official, but unofficially called the real estate professional designation. And it's basically a designation that says, hey, I spend all of my time, or to put some numbers behind it, 750 hours a year in
Right.
a real property trade or business, right? And
More than half of your time. Those are the two significant tests of that.
And it's more than any other time you would spend in any other types of activities, right? And if you go look at those real property trade or business rules, it's not just am I in real estate, right? I mean, there's things like construction that are included in there. There's a lot of things that basically, if you're dealing with real property, land, or real estate in some shape or form, you may qualify. But then, so basically, if you're a real estate professional, right, you can say, I do this for a living. There's an election you can make on your return and say, hey, I meet all this qualification to become a real estate professional. So what does that mean to you now? Well, assuming that in all these real property trades or businesses, you would materially participate, which is another hour rule that says, hey, I spend at least 500 hours a year, which if you're a real estate professional spending 750, you're probably spending 500 hours or more either on a particular property or across many properties. Again, those are a whole separate set of elections that you can make to meet those rules. But assuming you meet those two, then those losses that are now passive, you can now deduct those, right? You can deduct those to offset your other income. So now if I've got some properties that maybe have losses because of those favorable depreciation laws, I don't have to wait for those properties to turn a profit to take those losses. I can offset those against maybe my other properties that are already turning a profit.
Right. Or even other income, your spouse's income.
Yeah, definitely. And so again, it now says, hey, I'm basically in for a living, I live and breathe real estate. I'm involved in it enough to where I can treat this like any other ordinary trade or business, right? Kind of like the manufacturer I mentioned earlier. So again, it speeds up your deductions, it has a lot less limitations on when you can take those losses. So again, speeds up those and able to offset all other forms of income.
Yeah, and a few other nuances to this is the real estate professional. If you're married and file a joint tax return, only one spouse needs to be a real estate professional. So hypothetically, I'm an accountant. That's my day job. I'll never be a real estate professional as long as I'm a full-time CPA. If my spouse, however, qualifies as a real estate professional, any real estate investments that we own that we qualify under that material participation standard can qualify for that favorable treatment. So it's either spouse that could be a real estate professional can have that. So you can have instances where somebody has a profession other than real estate, have a spouse that is a real estate professional, and still get to take benefit for these rules. The other nuance we've seen over the, oh, go ahead.
No, I'm saying, and one other thing I want to clarify is we're not going into detail here, but there's a lot of elections and things like this surrounding these. It isn't just, well, now I can deduct these, right? We have to declare this to the IRS. So just make sure that you go and look through the rules, talk with a professional, talk with somebody about making sure all the proper elections are being made, because the time to find out that election was not made is not the time whenever the IRS starts questioning things, right? But it's making sure all those are done properly year to year to make sure that you can still benefit from being a real estate professional and deducting those losses in the year incurred.
Absolutely. I mean, records are key with any area of tax law and tax position. It's having good records of time, activities, what you're doing, how you're doing it, and there is a lot of nuances to this. The other one nuance to the real estate professional that I think is a real big benefit is if these incomes are non-passive, then they're also not subject to what's something called the net investment income tax. So the net investment income tax was a 3.8% surtax on investment income that was brought about by the Affordable Care Act once you exceed certain income thresholds. So for instance, Kevin, if you and I own an office building and then we sell it and we have $1 million capital gain, that $1 million capital gain is subject to that 3.8% surtax, right? So it'll be $38,000 of net investment income tax we'll pay on that gain. Well, as a real estate professional, you're not subject to that on items that you're active in. And so you literally will save that much money right off the top on a gain because of that real estate professional status. So we've seen a lot of clients that we've picked up over the years that they weren't taking advantage of that real estate professional classification, had big capital gains, and were paying those taxes that they really weren't subject to. So that's a really significant item to really just pay attention to.
Well, and that's a good point, because it's not just for people who have losses that we're trying to take. It's for people making income and then selling those properties at a gain that can benefit from it as well.
Yep. So another area that gets to be tricky, and I think you and I both are really big fans of retirement plans, right? And so I tell clients all the time, and they say, hey, I want to save taxes. And I say, great. The only way to save taxes is to spend money, right? And so retirement plans are unique in that you can have a tax deduction and you can also keep your money, right? So it's a great way to set yourself up for the future and get tax benefits today. But this gets a little tricky in the rental realm. So why don't you kind of walk us through that?
Sure. Well, like I said earlier, there's just a special section of the Internal Revenue Code always for real estate people, right? And this is one of them. So rental income is not considered earned income. A lot of times when we're talking about putting away money for retirement, the IRS bases how much you can put away based on your earned income. Mm-hmm. Well, rental income is not deemed earned income. So a lot of times what we'll see people do is they'll say, they'll set up a management company and say, hey, I've got several properties that I'm managing, I'm doing. We should pay out a management fee for that, right? And so they set up a management company in which a management fee is paid out to, and management fee income is deemed earned income. Mm-hmm. So it's a great way that says, hey, just with a little bit of tweak to your structuring and all, and then you can keep operating essentially the way you are, but now we can generate some earned income to help you put away some more money for retirement. And like John said, you get a tax benefit along the way.
Yeah, and it's a great way. And honestly, over the evolution of a real estate company, at a certain point, when you hit a certain mass, it makes sense to centralize your business operations into a management company. You just need to be careful on that the relationship really makes sense from a common sense or a bona fide standpoint. You can't charge 75% management fees. It has to be reasonable market rate management fees, but I think it does give you some leeway into structuring to take advantage of some things that may not be available if you're only looking at owning rentals directly. So a big area that you can influence your taxes from year to year is your method of accounting. And so a lot of rentals are on what's known as cash basis of accounting. And so how does that work, Kevin? And how can you use that to kind of manage your taxes from year to year?
Yeah, so cash basis, it's pretty much like it sounds. As cash comes in, right, as in the form of rental income, you're going to incur that, you're going to record that, and you're going to pick that up on your return as rental income. And as cash goes out for those properties, expenditures and so forth, you're going to be able to deduct those or potentially capitalize those depending on what the expenditure is. But you're going to record that in the year that the cash actually goes out. So this isn't for somebody who owes you rent that hasn't paid you yet, maybe come the end of the year. This is somebody who's actually paid the rent. As you collect that, you're going to pick that up as an income, and as the money goes out for various expenditures, you're going to deduct those or capitalize and depreciate those. So again, you have a lot of control there over your income for the year. So for instance, if you've got maybe near the end of the year and you're having a big year and you're able to push off maybe some of the rents, maybe some of the collections on those rents until January, February of the following year, you can sway your income a lot there, right? Same way, maybe you need to go ahead and do some of that repairs or that painting or whatever may need to be done. You can go ahead and say, hey, I'm going to go come out of pocket for those between now and the end of the year and go ahead and incur that deduction. Again, it's all about control. You can kind of control when those expenditures happen, therefore when you can deduct those, and when that income comes in, you have a little bit of control over that to control what the ultimate outcome on your tax return would be.
Yeah, and I think that's the most significant thing. Like I said, you can control the timing. So we don't ever say, hey, do this just so you can save taxes. But if in the next 6 months you're going to do an entire repaint of the property, and somewhere in the middle of there a year end falls, you get the decision. Do I take the deduction this year or do I take the deduction next year? So you can have some careful planning and really kind of lay out, here's the amount of taxes that, or the amount of income that I want to get to, and manage that through your expenses on cash basis.
Definitely.
And so the final area to really touch on is the business interest limitation. So the code section here is 163J, which is kind of what we always refer to it. The 2018 tax reform added this provision in, and they put in this small taxpayer exception, and small taxpayer is defined as less than $26 million of gross receipts. So small taxpayer is pretty broad, and most companies are not subject to that $26 million threshold. But where it gets really tricky, especially in the real estate space, is there's another exception that says if you're a tax shelter for tax purposes, then the $26 million threshold doesn't apply. One of the definitions of a tax shelter is a syndicate. And so when you drill into what does a syndicate mean, it means that more than 33% of losses are allocated to a limited partner or a limited entrepreneur. So when you start breaking that out, you say, okay, Kevin, we own a property, right? And we manage it, and we're 100% active in that property and really, own it and manage it day to day. We have less than $26 million. We're good to go under these business interest limitation rules. But if we bring on two more partners and they're silent partners, right? They just invested capital and they hope that we do a good job and bring them returns. All of a sudden, if we have losses in that entity, 50% of those losses are being allocated to those other partners. And we really have to take a hard look of whether or not we're a syndicate. And if we are, we're subject to these business interest limitation rules. And so the interest limitation basically limits the amount of interest that you can deduct to 30% of your net income. And then there's some changes with the CARES Act, but that was the original rules. And then there's some add backs for depreciation and interest and that sort of thing. But some of those go away in a few years. So it gets really complicated and can, frankly, is something you really need to plan around. The other thing is again, there's special rules for real estate, is there's an election that you can elect out of those rules. but you have to change the depreciation method on your assets. So instead of being under what's called MAKERS, which is the standard accelerated depreciation for tax purposes, you have to be under ADS, which is an alternative depreciation. There's some planning around bonus depreciation. So we talked about qualified improvement property. Under ADS, qualified improvement property, you can't take bonus depreciation. So it can be pretty significant consequences. And so really you want kind of a careful evaluation on, is it better for me to be subject to these rules? Is it better for me to elect out of them and take the hit on the depreciation? What's the timing in terms of how long am I going to own this property? And there's a lot of different factors and it gets really complicated. So just that's something to be aware of, that it's out there. And especially if you have investors that are not active in your business, it's something you really probably need to address.
And it's a good point, John, because with rates at historical lows, they're still really great. Whenever you go to buy even a property, right? That can be one factor among many to help you determine, hey, are we going to finance this? How much are we going to finance it? Do we really need financing? Are we going to run into any troubles with these rules or so forth? Just again, one more item to discuss with someone or to look into to see if that's going to affect any sort of negotiations you may have up front on even when purchasing a property.
Yeah. Well, that's all the time we have today. So Kevin, thank you so much for joining us. Really appreciate your insight. And, this is something that if you're operating real estate, you really need to work with a CPA who knows their stuff and deals with this on a daily basis, because there's a lot of nuances and there are a lot of special rules, and really want to make sure that you're optimizing the best you can. So have a great day, everybody. Thank you.
Thanks.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.